Well, Fed Chair Jay Powell testifying for a second day on Capitol Hill. Stock futures pointing to a second day of gains. Traders looking for any hints or clues on the timing of that potential first rate cut. Now, Jay Powell likely to strike a similar tone to what he did yesterday on the first day of questioning, when he once again reiterated the Fed is in no rush to cut rates.
We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence.
Here with more, we want to bring in Andrew Levin. He's a former special advisor of the Federal Reserve Board. Andrew, it's great to see you again. So nothing necessarily too surprising yesterday from Powell when it comes to that timing of the first rate cut here. The Fed wants to be a little bit more confident before they make that first move. Do you think that next move is necessarily going to be a rate cut, or what else could be on the table at this point?
Well, I think it's interesting that somewhat unusual that we have a congressional hearing 2 weeks before the next Federal Reserve's monetary policy meeting. So what you might think of as yesterday and today is kind of a preview of the press conference that Chair Powell will be giving in 2 weeks when he announces their next decision, and they will release a fresh set of projections of the outlook. What I'd say, I think, is that the outlook that they described in December is pretty close to the outlook that they seem to have now. So in December, the markets were thinking the Fed might start cutting rates as soon as March. That's clearly not going to happen now. As of December, Fed officials were expecting to make 2 or 3 rate cuts. And now I think it's more clear to the markets that's going to probably happen later this year. Could be June, but could well be July, August, September, somewhere in that time frame would fit better with what Fed officials have probably been thinking all along for the last few months.
When we listen into a more data-dependent Fed and try to kind of linger on every single word, it's becoming more evident that there's a trend that they're looking for that perhaps is different than what the markets were expecting them to zero in on, and not being satisfied with just, a 6-month or a 3-month trend of getting inflation back to a 2 handle. From your own experience, what is that trend that they could be or should be evaluating?
Well, I think it's interesting because last summer, Chair Powell was really emphasizing that they're looking closely at what's happening in the service sector. They know that goods prices of refrigerators and cars can move up and down a lot. Those tend to have a lot of fluctuations, some of which are fairly quick. Where service inflation tends to be very inertial, very slow moving. And so the challenge the Fed is facing right now is that service inflation is about double where it was before the pandemic. And that means that for the Fed to really be sure that inflation is coming back to their target of 2%, they really need to see clearly that the service sector prices are slowing to be much more consistent with what service prices were doing before the pandemic. And unfortunately, this latest CPI report wasn't consistent with that. The latest CPI report said that a lot of prices in the service sector are continuing to move pretty fast, including housing, but also many other dimensions of the service sector. So I think that reinforced the caution that you've been hearing from Chair Powell about. They say we're highly attentive to inflation risk. Well, that's it.